Best ever listeners, welcome to the Best Ever CRE Podcast. I am your host, Joe Cornwell, and today I'm joined by Jeff Ervick. Jeff is the owner and operator of Valoris Capital Partners. They are doing all kinds of different types of real estate with over a $200 million portfolio. They're doing multifamily, single-family builds, ground-up development, industrial, and he has done a lot of investing as both an LP and GP. It's Jeff's first time on the show, so welcome, Jeff. How are you today?
Hey, Joe, I appreciate it, man. Thanks for having me. Doing great, bud. I mean, minus right now, it's raining out here, but besides that, it's a beautiful time to be alive. That's for sure.
Well, and I didn't mention that. So where are you based and, kind of primarily investing?
Yeah, no worries. Yeah, so I'm based out of Annapolis, Maryland. We primarily invest in the Carolinas, Florida, and Texas region.
Okay.
We do have a couple other properties that we're partnerships in Minneapolis and Arkansas, but that would say primarily those are the markets we're focused in.
Very good, very good. And as I mentioned, first time on the show, so
Yep.
Why don't we tell a little bit about your background, where are you from, how'd you get into real estate?
Yeah, sure. Excellent. So yeah, I've again live in Annapolis, Maryland. I've been in technology sales for the better part of 21 years, I guess it is so far. In that time frame, I've only worked for 2 different companies, so I'm very loyalist when it comes down to that. And I love to be able to be a part of something that can grow and be bigger than myself. So with that being said, I also had an opportunity to start investing in real estate. So back in 2017, I bought my first rental property. That was one of the have an auction in front of the house, right? And put your hand up. It was freezing cold and so forth. So that was kind of my first dive into real estate.
And that was in Maryland?
That was in Maryland, yep.
Okay.
Right outside of the Baltimore, Maryland area. And since then, I've grown my portfolio from just single family to private lending, and now I was looking to scale a little further, right, outside of the single family, because as working a W-2 and trying to build a single family portfolio is pretty difficult in my mind, right? So at least I'm sure there are people who can do it. I was looking for a way to scale the portfolio bigger and start investing into multiple different asset classes as well. So I found a mastermind with multifamily investments. And from that, I joined the mastermind, kind of learned as much as I possibly could. But really, I wanted to network and find like-minded individuals who were interested in doing the same thing I was doing, but also maybe had different skill sets. And that's when I met my partners at Valoris Capital Partners. And since then, we've acquired value-add multifamily, ground-up development, light industrial. We've done some single-family luxury home construction. We just launched a private credit fund as well, too. So we're doing private credit as well.
Define what do you mean by private credit?
Yeah, private credit is essentially a loan to a business that is subordinate to a senior debt, right? So you've got your senior debt, and they're looking for a cash infusion to either refinance or restructure the debt. So we bring in our private credit fund to help kind of get them to that point. The private credit fund is then also paid as a loan, right? It pays a current pay and then also accrues a pay for the future as well too. So it kind of gets
Is that similar to, like, I've heard other people talk about, like, the mezzanine debt? Is it similar to that? It sounds like maybe on a smaller scale.
Yeah, it's on a different scale, but yeah, it's in that same kind of position on the capital stack.
Gotcha.
As that, yeah, but it's a preferred private credit loan, yeah.
Okay, makes sense. And so one of my first questions that comes to mind with the little bit of your story you've told us is that I think you said you're still working in a W-2. Obviously, you've built a pretty substantial portfolio that you've invested in and you're part of. And what is the mindset behind staying in the W-2? My assumption is, based on all that you've done, is that you could probably go full-time in real estate and it would make sense to do that. But what is your mindset behind staying in the W-2?
Yeah, so I love my job and I love what I do, and I'm really good at it as well too, right? So that's a good thing, and I like to be able to utilize that W-2, and I help guide people in this as well too. Like I've got an ebook or a guide based on how to create multiple streams of income utilizing your W-2 as well on our website. So we'll link that in the show notes also. But my motivation for staying in there is that I I would love to have a chance to be able to, work in this opportunity and then take that any capital I do and then start growing my portfolio out that on the back end, right? So I utilize the income from my W-2 to do that. Now, eventually, maybe sure I might retire and move into real estate full time, but I've got no plans to, nor do I want to at this point. I'm really good at managing my time between the two as well.
Yeah.
So it helps to have that, utilizing my time wisely. And I'm also married. I've got 3 kids. I coach, youth sports. So having time management is key to being able to build a company, but also having great partners too as well. I mean, I think that's a big thing that a lot of people underestimate, is that if you surround yourself by great people and have great partners, then you can grow your business that way as well too. And that's kind of what I've done also. Yeah,
absolutely. I mean, that my assumption was your answer is going to be somewhere in the lines of having great partners that you can lean on to make sure that no one's dropping the ball at any piece of your business. And obviously, given the size of the real estate portfolio you have accrued, that would be my assumptions. There is a lot of management time, a lot of time in managing that size of a portfolio. So what is it that you would say in your business is your kind of day-to-day function? Like what do you specialize in, and what is your piece of your business that you operate?
Sure. Yeah. So I handle all the investor and partner relations. Bringing in new investors, talking to investors about opportunities, investor relation duties of, we write the newsletters and make sure we're keeping tabs of all the properties, all the projects we have, so our investors stay aware of what's going on and how that is moving. And then our partner relationship side as well too. So developing relationships with our partner and our ecosystem. So we also have a very good partnership ecosystem of folks that are joining us on our deals, co-GPing with us as well. Building relationships with family offices, with equity brokers as well. So I kind of match everything on that side. And then I've got a partner who runs all of our operations and asset management and acquisition side. So that's where I said having good partners that can do have the same mindset, same goals, same motivation as you, but have different skill sets. That's the important part. And
right.
A lot of people don't realize that you can't really have 2 great capital raisers on your team, because you need somebody obviously to manage the assets and manage the operations in the back end, which there's a lot that happens there that most people don't see. Right.
Yeah, absolutely. So you started with buying some single families, you moved into multi, and how did you find your partners that you are partnered with today?
Yeah, so we had separately joined a mastermind program similar to the one that you guys have as well too, and then we through that networked right with a few different folks, and then we were all raising on a deal together and being a part of a deal that we closed, and we said, hey, why don't we just do this as a partnership instead? So we did that together, and that's where we sat down and had the same values, ideas, like I said, mindset, motivation, to be able to grow the business and be able to grow our portfolio bigger. And I think I touched on this earlier too, but one of the reasons why we invest in value-add multifamily, ground-up development, light industrial, custom home building is that I personally wanted to diversify my portfolio and create multiple different income streams that come through within the real estate asset classes, right? So I think that's a lot of things people don't really they say, hey, I just want to invest in apartments, right? So they just go invest in apartments. But if you diversify your portfolio in the real estate side, you also get an opportunity to be able to exit at different times, cash flow at different times, depreciate at different levels and different times, and it really helps provide a very stabilized portfolio where you won't get that in like just the stock market, or you won't get that in just single family homes and so forth. So having that diversification was key for me to be able to grow my portfolio, and why not do it as an owner as well too, right? So that's kind of where I got into that.
Now, do you guys so these individual deals, are they single, like syndication structure? Do you guys have a fund that you use to do multiple deals within the fund? Like, what is your model?
Yeah, they're usually syndication style.
Okay.
We also have some joint venture deals as well. So it just kind of depends on the deal itself and specifically what is required for that.
Okay.
Majority of them are syndication. So we'll do 506C syndications for accredited investors. I would say about 90% of our deals. And then we have a couple of joint venture structures as well too, which were for some custom home builds and some large, a different large deal as well too. So it just kind of depends on the specifics of that deal.
Okay, got it. So you don't do any of the overarching funds where you can, you're doing multiple deals within that single fund structure.
Well, we do have that. That was, I mentioned earlier, the private credit fund that we created as well too. That is a fund that has the opportunity to invest in multiple different deals in different asset classes and provides that kind of level of return to our investors on a monthly basis. So our private credit fund is set up and established where our investors earn up to 14% return on an annual basis, but it is paid in a current and accrued basis. So we guarantee, or you can never guarantee, right? But we're paying a 6% annual distribution distributed monthly, and then it accrues up to 14% as well too.
Gotcha.
Yep. So that is our fund model that can invest into multiple different deals.
Okay. And these are deals that you guys are typically sourcing and then investing in other operators' deals, right? These are not deals that you guys are sponsoring yourselves.
That's correct. Yeah. So usually it's going to be another operator that will come to us and say, hey, we're looking for a private loan or a private credit to help come in and satisfy this certain need we have. Now we vet the properties, we vet the deals, we vet the businesses, the owners, the sponsors, to ensure that the deal itself meets the economics that we need, right? Not every deal that asks us for private credit is going to be is going to suffice for our fund or pass our rigorous tests, right? But it has to be economically feasible, right? So that way the deal itself is already being able to meet debt service, meet cash flows, and just maybe need to restructure that debt or restructure a certain partnership of that. But for example, we're not going to invest in something that's underwater or can't refinance or can't restructure because maybe they need extra cash for paying the debt service. That's not a good use of our time or funds. Or it also that doesn't de-risk our investment like it would if we were investing specifically in a loan that's going to be refinancing that business, right? Yeah.
So, now you are invested in a ton of different asset classes. It sounds like you're in several different markets. You're in the South, Southeast, and obviously it sounds like you still have some of your kind of personal portfolio in the Northeast. What asset classes, and we're recording this, at the kind of nearing end of Q2 in 2025, what asset classes and markets are you most excited about today?
So there are a few different ones. We're still excited about the Carolinas. We still think there's a lot of opportunity there. I think the Carolinas provide a best opportunity being, I'm an East Coast guy too, right? So I like the East Coast. But we still invest in Florida, so I still think Florida is a good market too. Depends on certain areas of Florida, but you've got to worry about your insurance costs and hurricanes and so forth and that sort of thing. So the deal will have to work out pretty good for that. But you get the same level of income and same parameters in the Carolinas with less of an insurance cost, less of a tax rate. You've got opportunities for tax abatements that really can work out in your favor, right, to own this property. So we like that area. We like different markets, I wouldn't say your primary markets in the Texas region. We're not investing in Dallas. We think that's an oversaturated market. We're not going to go in Austin because I think a lot of the tech is leaving the Austin area. I do like San Antonio. I do like some tertiary markets as well too. I do like an El Paso market. I'd be We've got a number of different things. In fact, one of our partners runs a study. He does an 85 MSA study, and so we're targeting those markets as our next venture. And through that is like numerous parameters, right, that kind of boil down of these 85 markets and how. And then we isolate and focus on top 10 of those, from his proprietary due diligence checks, right?
And what type of assets are those?
So we are our I would say our previous we've done were heavy value add, right?
So this is all multifamily, or
mostly it's all multifamily.
Okay.
Heavy value add. We are steering away from the heavy value add at this point.
Define heavy value add for me.
So I would say like a Class C market, Class C asset class that is lower on the occupancy side, needs bridge debt, something that has either you're redoing most of the units, if not all of them, and it depends on So I would say that would be like a heavy value add. You need to bring a lot of capital into the deal, fuse the capital, right, and then take a year or two to stabilize the property. We're seeing that a lot of those deals don't necessarily cash flow, which is, again, another reason why we opened up our private credit fund. So it offers our investment pool, right, an opportunity to invest in some very depreciable assets, but also have a consistent return for their investment with a private credit fund. But we're also focusing in on closer to like Class B type assets built in the early to mid 2000s. So we feel that is a good target where, and especially if it's a lower unit count, so maybe it's in the 70s to 170 to 100 unit count where it's underneath your institutional level, and it still has a value add component, but it's not like you've got to completely gut each unit. It's more of a, hey, we're going to update the counters. We're going to, do an appliance package, so do a light paint job, mom and pop type ownership, right, still. So I think those are the assets that we see are really the ones that you can really make the best or have the best bang for your buck on, and be able to really grow the portfolio that way. Because they'll still cash flow year one, and they'll still provide that depreciation and also that equity play in that 3 to 5 year time frame.
Yeah, and I couldn't agree more. I bought a 40 unit here in Cincinnati a couple years ago, and I would even call it, maybe it's like right on the fringe of like D to C class. So it's lower income neighborhood, 1950s vintage, and I definitely underestimated just. Not even so much. So I have a construction company, kind of construction background. So I look at a lot of deals through that heavy value add lens you mentioned, where that's my expertise, and that's how I know I can add the most value to deals is through the construction component. But I underestimated just how much management time, the type of tenants it's things you wouldn't even think about, and it doesn't sound like you're invested in any of that at quite that level. It sounds like you're probably the next step up, and you were doing that 60s, 70s, 80s type vintage, which, the very traditional Class C stuff. Yeah. But it's, I'm sure in certain markets, even that it is an entirely different type of tenant, and I've definitely shifted more of my portfolio into that Class B stuff, and it is night and day. It's like your return on your time is so much better on a Class B asset compared to a C or D. It's and I think as investors, and you kind of alluded to some of this, we constantly have to reevaluate through our journey. If you're going to continue scaling up and investing and growing your company and growing your business, there's a time and a place where that Class D stuff makes a lot of sense, and you want to get into stuff at a low basis, and maybe you're limited on capital, you're limited on your ability to raise capital. But as I get a little more gray hairs that you might be able to see a few of here, I constantly have to reevaluate what is my time worth, and what is my bandwidth going to allow me to focus on. And more I am seeing the upside and paying a premium, and even maybe compressing ROI financially, just to have a lot more ROI on my actual time I'm putting into these deals.
Yeah, I agree. I mean, and my first couple rental properties I mentioned that I bought as a single family were just that. They were Class D type of properties, and it was your traditional BRRRR method, right? So you buy it, the bigger pockets BRRRR method, right? So you buy it, you rehab it, rent it out, you refinance, and you repeat. And that was the structure that I did for those properties. And it sucks a lot of time, right? Because you've got a lot of time with managing that construction. Then you got to go back to the refinance process. You got to find a tenant. You got to find a good tenant. I've had multiple evictions in a few of my handful of rental properties, and it kills your cash flow, which again, that's another reason why I said, you know what, I need to scale up into multifamily, where if you have an eviction out of 100 unit and you got a couple of evictions, that's not going to hurt your overall bottom line. And it provides a more of a reassurance, right, that you're doing the right thing for the right property. And I do love the being able to take that ugly duckling property, right, but that's still in a good neighborhood, and it was just like the eyesore of the property of the neighborhood, and then revamp that. So we've done that with a few of our properties right now, and it kind of makes you feel good that you can do that and still make a return on that, right? Because it helps the community out, it helps the residents of that community, it helps it overall brings the community into a very I don't know how to explain it, right? But it makes the community better, right? It makes me feel good that I'm doing that and helping people live in a really nice area. Because the last thing, like we've acquired some properties, and I've acquired some single families as well too, that were just bad, right? And you mentioned it, like yours, like you walk through that, you're like, man, like how do people live in this situation, right? How did the previous owner just neglect it so bad that their people are living in such filth or in this environment? And it's because people don't care, right? And I think I'm one of the kind of guys where I always love to make something better than where I got it, right? So that to me holds true in everything we do, right? That's also another reason why when you first get into value add and multifamily, like those are probably the deals you're going to find that are going to pencil well, and they are going to have a good return. They're going to have a good equity multiple on it, and if you can refinance it in 2 to 3 years, you're going to have a good IAR on it. So the numbers look kind of sexy to your investors, but the work behind the scenes is a lot, right? And if you don't do, if you're not attentive to all the needs of that property, you could falter a little bit on the outcome as well too. So.
Yeah, I mean, and like I said, for me, it's just the time. I mean, that one property is 25% of my portfolio, but it's 75% of my time, and it's so you just over time you start to think about like, man, this is a constant headache, a constant problem. Can I take my equity I built in this property and just sell this and put this money into something that is going to be way less headaches, way less of my personal time invested in the operation of this deal.
I mean, Joe, if you've got if you're looking to sell that property and you're looking to place some capital, we have some investments. So,
yeah.
But I think that would be a good, obviously, like it's scaling up, right? So getting into that like that 40 unit, right? And then you've done the work, you put a lot of time into it. So you have to look at what is your return on your investment and also return on your time, right? Because that's important, because that's one thing we don't get more of is time, right? And so if you can maximize the amount of time you have and put it into a better use for yourself, right, and for your family, I think that's very important. And I love to do that same thing.
Yeah, I mean, I think that's the way, I'm looking at things. I've been in real estate almost 10 years now, and one of the biggest and most important parameters of a deal when I'm evaluating it is how much headache and time and stress is this deal going to cause me? And that's as important, if not more important than, the actual financials and the ROI on the investment. And anyway, okay, so let's spend a little time on your development stuff. Like, walk me through some of the developments you guys are working on. What type of assets? What markets? Why do you like it? And then I'll have some follow-up questions.
Yeah, sure. Yeah, so we're currently in St. Petersburg, Florida. I do mention I do love the Florida area, Florida market. I'm a big fan of Tampa. Even for me personally, I like that area. I've been down there a bunch. We met again through our network. We met a partner who we said we want to work together and do some development projects. He had some opportunities, so we kind of jumped in aboard with him as well, and started being a part of that team to develop 374 units in the St. Petersburg market. We've got 3 plots. So one is a 150 unit, 16-story mid-rise. Right across the street, there's a 150 unit, 5-story wraparound building. Both of those will share amenities with the high rise. The high rise is a Class A. I call it a affordable luxury, right? Because it's going to be a Class A building with Class A amenities. Rooftop pool, covered parking garage. It's going to have cafe, mail room, front desk, that sort of thing, right? But it's smaller units, right? So it's kind of more of affordable housing, so to speak, right? Where a lot of that market has your 2-3 bedroom units that are charging $3,000, $4,000, $5,000 a month in rent. Well, this will be a little bit lower than that. This will be 1-bedroom studio bedrooms, a couple twos in there. And the market that we're targeting is roughly about that $2,600, $2,700 a month payment. So it's a great for your working class single person, somebody who's in a new role. Maybe they're looking to live and they want to live in that St. Petersburg market. And then we also have another plot that's going to be an 5-story 74 unit as well too. Similar kind of demographic, similar kind of set for that. So we own the properties. We are finalizing our schematic design sets. So we've got that done. We've identified our construction contractor for the 150 unit, and now we're going through the final plans with our architects. We're about to get our permits scheduled here soon, and our goal is to start developing and breaking ground on the 150 unit. Last I heard, the target was like January of 26.
Okay.
And then sooner than that, we're also meeting with some equity partners and some development partners for our 74 unit as well too. So both should be able to start construction within the next 6 months.
Okay, great. And so your company, it sounds like, if I'm understanding you correctly, you guys are finding the land. And are these existing properties you're doing teardowns, or is it raw land?
Yeah, so there was it's a mix of both, right? So one is raw land entitled. We bought it as an entitled property. Okay. And we're finishing out the plans and permit side. Then the other one had pre-existing buildings on there that we demolished. One was a commercial property that we demolished, and the other one is a couple of residentials that we compiled into 2 lots into one for that as well too. So yeah, it's kind of a mixture of both.
Okay.
I would say majority of stuff we do, we buy either entitled or we bought it and now we're bringing it through entitlement.
You're entitlement. Got it. And then you're contracting builders. So this is not something you guys don't do like the actual construction side in-house. This is something you partner with a GC or a building company.
Yeah, that's right. And part of our team is we have an owner's rep who is a general contractor as well. So that helps us to make sure the property or the project is steered in the right direction. We've got, he's local to the area, so he knows the market, nice. He knows all the players, knows all the architects, the engineers, the permits, and so forth. So having somebody, and he's got institutional level background, right, from building, 300-400 unit multifamily properties across the East Coast for a large institutional builder. So bringing somebody into our team was critical, right, to make sure we had the right path moving forward. But yeah, I'm not your construction GC. I'll put it that way.
Yeah, I got you. Yeah, no, it's so interesting because like I mentioned to you, part of the way I'm taking this show, my particular segment within Best Ever, is focused on that ground up and development side. And it's so interesting to me what I've learned, even in the last 6 months of like, there's so many ways these deals get done. There's people who are just on the capital side. There's people who are actually out there, in the field, kind of like I am every day, like working, with their crews. And sometimes it's in-house, sometimes they contract things out. But yeah, there's so many different ways to make developments happen. And I love learning about every aspect of it. Now, with your guys' development deals that you're working on, are there any sort of incentives you're getting from local jurisdiction, state, federal? Like, what does that look like?
Yeah, so it depends on the market, right? There's a couple different things we look into in the Florida. Like there's something called a Live Local Act, which provides a tax. It's basically a tax abatement on the AMI of that area. So it just really depends. Now, I don't know if
what's AMI?
Your average medium income of
Okay,
the area.
got it,
So
got it.
basically,
Okay.
basically, if you've got so Live Local Act in Florida is a way for property owners to have a tax abatement based on the amount of people you have who are like maybe at 80% of the AMI based on those units. So
okay, so it's based on it's going to be based on what you're charging for rent related to the income levels.
yeah, it's
the
right,
local
income level
Got
and
it.
the market side. So keeping it
Okay.
in a again, so the market rent. Right, if the market rent is $3,000 and we're charging $2,600, that keeps it below market rent. And then if we
Gotcha.
have somebody in there who is like at an 80% of the AMI of that local area, then that provides us that tax abatement, and also
Cool.
it still cash flows as well too.
What does the abatement look like?
It would depend on the unit itself, or sorry, it would depend on the amount of designated units, right, that are for that
Affordable housing. Yeah.
affordable housing area.
Okay.
Now, it's not like your LIHTC program or your Section 8 vouchers. It is, people who still pay their own rent, right, but also might not be at that 100% local or medium income of that area.
Right. Okay. So it's like a percentage basis of how many units you're going to have under this program that's going to give you a percentage of abatement.
Yeah, exactly.
And is there a timeline on these? Are they all different or?
I believe it's all different. So, it depends on the program, and some of the jurisdictions are different than others. So, I let my partners handle that one. So again, I'm not. Remember, I said I've got an operations and acquisitions guys, so they handle that stuff. So,
Gotcha.
They'll know more about all the specifics and parameters of that, right? But
Yeah,
it gives
And
us.
I mean, the reason why I asked so many specifics on these is because what I've found in talking to a lot of developers and builders is that almost unilaterally there's some sort of incentive structure to get these deals done. And all because the cost of construction is so high, because labor costs are so high, material costs, you almost have to have some sort of incentives, whether that's state, local, federal. I will say the one exception to that I've found multiple times is there are markets in Texas where I've heard people who are flat out, they can buy land so cheap and they can get labor so cheap. My guess would be I'm going to take a wide leap here and say that they're probably getting a lot of, lower labor immigrant, close to the border type thing would be my assumption. But that either way, they're getting really cheap labor and they're able to literally make deals just work on the fundamentals, right? So the market rent's so high, they get land so cheap. They get no incentive from local, state, or federal, and they're making these deals work, which is insane to me. It's like I can't even wrap my head around the numbers of how they're doing that. But outside of some markets in Texas, that is the only exception I've heard. Pretty much everywhere else, every other market, people are getting incentives if they're doing new construction.
Yeah, I mean, it definitely helps, obviously to alleviate some of the construction costs, right? Because you said the rising costs happen from both the labor market and also the materials as well too. With tariffs are kind of like a moving target, right?
Yeah.
So you kind of have to just use your as best as you can to your judgment of where you think it's going to be. I would say in 6 months, and
Right.
then hopefully I would say the underwriting of that is important.
That was my next question. What conversations are you guys having? Obviously, it sounds like more with the operational side and potential construction builder partners. But like, what are those hedges you guys are trying to make in the face of potential inflation area factors of tariffs?
So I think it's you when you're interviewing and constantly keeping tabs of the market as well too. So The beauty about our partner in one of our deals is that, he does keep those kind of tabs in the market. He knows the market, so he's constantly pinging, constantly talking to the construction teams or the different, GCs, the big, large GCs. That way he can kind of gauge, hey, where are we at, right, on a per square foot, linear square foot for construction costs, and where can we make sure that our target number stays in that range, right? So if that drops a little bit, that's great. If it raises a little bit, we still have a buffer.
Gotcha.
So having that kind of level of knowledge of your market is key. So you can't just go into any market and be like, oh yeah, I'm going to build and it's going to be 300 square feet, or $300 per square feet or something like that, right? You have to know like intimate level of that knowledge of that market and the MSA, and what those construction costs are going to be. I think that's the best way to really understand, how you underwrite that deal.
Now, we can use a real life example, or you can talk about hypotheticals, but you mentioned one of yours has about a 6-month lead right now until you can break ground, if I understood you correctly. So obviously we don't know what's going to happen in the next 6 months with the economy, with tariffs, all these other factors, or maybe in a little longer. I think you said January, so let's say 7-8 months. But I guess my question is, let's say we get to January of 26, you start breaking ground on these projects, and then all of a sudden we do get hit with some massive, unexpected costs. Is that something that you're going to go to your investors for? Is that something, because my assumption would be you're using some sort of construction financing to do these deals?
Correct, yeah.
Okay, so what would let's just say you did not have the contingencies in place for some reason. What would your next step be in that case?
Yeah, I think you have to look at different creative ways to bring in either equity or new partners, for that have that experience. So whether that's a preferred equity position. So that's one of the last things we hold out for, is, we've got our equity in a position from our general partnerships, some from investors, and then we'll obviously maximize our construction loan, try to find the best deal there possible. So that's kind of what we're currently doing now is shopping different construction opportunity loans and see where, what the loan to cost would be, or loan to value they would be able to give us. And budget in some overages in case there is the need for a preferred equity position. So that's obviously pretty expensive debt, right? So we want to make sure that we have those in place. So I would say, tackling it with a very conservative underwriting, right, from the construction point of view, and then also from a rental perspective, right? So maybe not necessarily because if you not necessarily putting in the tax abatement or like a Live Local Act or anything like that, right, into your underwriting, because if you can make that pencil with the current construction costs, the current financing structure, and the current rental market, right, then I think you're in a better position to be able to adjust and pull some of those levers a little bit differently, by adding in the tax abatement, which can then lower your taxes. Bringing in a preferred equity, which then can offset some of the additional costs that are on there, and then what your projections are for your exit strategy, right? Whether that's a refinance after you're about 90% leased up, right, and what that cap rate would be at in that certain market, and giving yourself some buffer there as well too. So I think if you pull all those different levers and you have all those contingencies in place, that helps you you're better suited for if something does go in the opposite direction of what you're thinking is happening.
Yeah, no, that's great advice. I mean, again, that's where I'm moving my businesses into these redevelopment and new development deals, and that's definitely my largest concern is that we're underwriting these projects. I have a business partner as well, and we're looking at, okay, where can things go wrong in this underwriting? Where can things go that we're not expecting? It's easy to underwrite for all the things that you are expecting, right? That's the point of an underwriting model. But I think if anything in the last 5 years, if we've learned anything in real estate in the last 5 years, it's that unexpected things happen all the time. COVID obviously being example number one. I mean, nobody expected COVID. Nobody expected a lockdown. after COVID, nobody expected interest rates to double and almost nearly triple in 6 months.
Sure, yeah.
And so there's nobody expected insurance and property taxes in many markets to double or triple. So there's so many factors here that are out of our control as operators, but it's almost like you have to try to plan for the unplannable. And I know that sounds kind of crazy, but especially in the development game, I think that's super important. Now, the easy thing, kind of the deal we're putting together right now, it's the easiest thing is just slap a huge contingency line item.
Yeah.
And we're right at the point of where we're presenting this with banks, hopefully getting banks to, agree with what we're looking at and say, hey, there is a lot of uncertainty in the market. Maybe it does make sense to earmark a ton of a contingency budget. But, my concern in talking to other developers is a lot of banks don't like that. A lot of banks don't want this point blank, kind of money here sitting on the sidelines if they don't have to commit it. So I don't know if you've ran into that issue, but that's one concern we have right now as we start having these conversations with lenders.
Yeah, I'm sure they don't want to have to earmark, a certain, bucket of money that could or could not be used, right? They like to know their certainty, right? Mm-hmm. Of how much are they lending and at how much is the rate, right? And what is the term, right?
Yeah.
Because they want predictable, right? Interest to come back, predictable returns. Where if you utilize maybe for example, if you utilize maybe a family office, right? Maybe that family office is the one who says, "Hey, listen, we'll give you, your construction loan at X, and then if you need a bit more, we'll have some preferred equity in there. We can use that as, as we creatively, match our capital stack to your project and to your location." That might be a better scenario because a lot of times these family offices do love to have, they love to be the debt and the equity on the deal, right? So
that makes sense.
It gives you a kind of a one-stop shop, right? Almost for providing the uncertainty, but also the certainty, right? That a bank won't want to do, right? So, yeah. So I mean, that might be an opportunity, right, to look at that because a lot of times family offices do love that development because they're gonna diversify their portfolio from not just being an LP in deal, but they want to be a developer or they want to purchase that and bring in their developer, right? So there's a lot of creative options that you can do if you work with the right partners.
Yeah, no, that makes sense. All right, we are running up on time here. Any other final thoughts you want to leave us with today before I ask you my last question?
No, I mean, Joe, I appreciate the time. I mean, it's been great to get to know you and your business, and hopefully, your listeners have got some value out of this, and looking forward to hopefully the next one soon, right?
Absolutely. So my last question for you today is, where can our best ever listeners connect with you and find out more about your deals?
Yeah, I would say the best way to connect with me is probably LinkedIn, right?
Okay.
So it's Jeff-Ervick, Ervick on LinkedIn. And then our website also has a bunch of information and ways for people to connect with us and even pop a meeting on my calendar as well too. And that's ValorisCapitalPartners.com. It's VALORIS capitalpartners.com. And in there you can see some of our where our fund is and different things that we have going on as well too.
All right, very good, Jeff. I appreciate your time as well, and really appreciate your background and all your deals and experiences you have.
Awesome, Joe. Hey, man, it's been a pleasure. I really appreciate your time also, man. Thank you.
Thank you. Best ever listeners, if you enjoyed today's episode, be sure to leave us a 5-star review and subscribe to the podcast so you don't miss any. Thank you all for listening. Have a best ever day.